One thing that the expected stimulus package does not include, and this is one of the issues that have been debated here between Democrats and Republicans now for quite some time, is the aid for state and local government. So here to talk about how this could potentially affect munis going forward, we want to bring in Jennifer Johnston. She is the Municipal Bond Senior Research Analyst with Franklin Templeton. And Jennifer, great to have you on the program. So no additional aid is expected for state and local governments at this point. How do you see this affecting the muni bond market, at least over the short term?
Sure. Well, there's a couple things to keep in mind. First of all, states have gone a long time waiting for revenue replacement aid. They've received aid in terms of reimbursement for COVID, those types of things. But what they're looking to do is replace revenue that's been lost through government shutdowns, unemployment, and that sort of thing. So this is important as we head into budget season, which tends to kick off in January. We expect many large state governors to be releasing their budget projections, and stimulus is probably going to play a role in that. One of the things that I think is interesting is as we prep for this sort of phase in a state budget cycle, we're starting to get some good news out of a lot of states that their revenues are coming in better than projected. So the doom and gloom that was projected back in May and June hasn't really happened. And we're seeing significant improvements in revenue coming into states. So even as we still wait for revenue replacement aid, states are doing better than expected, which is good for credit.
Yeah, Jennifer, how have states been able to kind of avoid those doom and gloom scenarios that we talked about for so long? Because it almost seemed like the states and local governments were in a helpless scenario a few months ago, but that necessarily hasn't come true, like you were just alluding to. So why is that the case?
Sure, there's several reasons, actually. First, going into the pandemic, we saw state and local governments performing very strongly, some of them having all-time highs when it comes to revenues, surpluses, and reserve building. So states went in from a position of strength, which definitely helped them from a cash flow perspective as COVID first hit and they delayed the receipt of income taxes, just like the federal government did. But we've seen a couple of other phenomenon. So first of all, employment has remained quite strong among the wealthy. And they tend to be the largest taxpayers, particularly in more progressive tax states. So with them all being employed and not being the ones laid off, we're still seeing a steady stream of revenue coming in from those wealthy taxpayers. So progressive tax regimes are actually helping in this case. Second, the market has rebounded, and income from estimated payments, from capital gains, those types of things, all of those things are doing quite well because the market has rebounded. And there's been nice IPO activity as well, which can also have a positive impact on state revenues as well. And then the final thing I'll point out is certainly the way we spend money has changed. You know, we're not traveling, we're not spending a lot on services, but boy, are we buying stuff online. And there had been a helpful U.S. Supreme Court decision, 2018, I believe, that allows states to tax internet purchases, even if the seller is located outside that particular state. So the timing could not have been better for that, which is allowing states to collect sales taxes on all of these purchases we're making and having delivered to our homes. And so that has really helped keep sales tax revenues flowing into state and local governments. And then finally, a lot of states tax unemployment benefits. And so we saw some enhanced benefits as part of the last stimulus package, and that's taxed in a lot of states as well. So a lot of things contributing to it.
Jennifer, real quick, we only have about a minute here, but with all that in mind, and as we look ahead to 2021, what's your recommendation then for how investors should be positioned?
Sure. So we think that muni bonds should be in anybody's portfolio. It is a great way to manage tax liability depending on where you fall. And Biden has talked about wanting to raise taxes. So munis could become quite a good part of people's asset allocation, especially if they want to try to manage their cash flow. So we're looking to see continued inflows. We've had a good year despite some setbacks on flows in March and April, but they've really come back, and we're up about 36 billion net for the year, which is great. And there's a lot of demand out there.
All right, Jennifer Johnston, Municipal Bond Senior Research Analyst with Franklin Templeton. Thanks so much for taking the time to join us.
Thank you.